When thinking about Kate and Tony and their story, what really struck me is the concentration of so much of their wealth in this one asset class, right? Australian property. And that's an asset class that has done phenomenally well. And what's a little bit frightening about that is that when something has done incredibly well over a period of time, it may be in a bubble. If you look at Australian property prices over the past 200 years, what you see is essentially a sort of a steady ticking around like this and then a shoot up astronomically high. There's a couple of reasons that that is likely to have happened. One is this really low rate environment that we're in. So the question is, can that persist? Is it likely that you're going to get those same returns going forward that you've gotten in the past? Because the flip side is, if you do see a correction in prices, the way we have seen in the UK, but also in the US, where the bubble popping in property is what started the global financial crisis, then it's really frightening when you think about the future options for this couple to have so much of their wealth tied in this one thing that actually looks potentially quite precarious. Another thing for Kate and Tony to think about is the concentration of their wealth in Australia. Now remember, Australia is about 3% of the world's equity markets. And so when you think about things that are going to correlate or move together, it does help if you can widen that viewfinder and have more choices, more options. So what we do at Orbis is we look across the globe at global equities, and not just at markets, but at individual companies that we think are undervalued. Now, Tony, self-confessed bargain hunter, right? He doesn't like to overpay for things. That came across very clearly. And at Orbis, we're exactly the same. We're looking for those companies that we think look too cheap, and then we want to buy them just the way Tony, say, fixes up a house and then sells it for more. We're not actually fixing up the companies, but we're buying the companies that look too cheap, and then we're waiting for those prices to come back to fair value. It's taking Tony and Kate's philosophy that they've already got and just broadening the horizons and letting them have and use that philosophy in a way that's probably less risky for them. I think one of the kind of easy check the box approaches is let's just index, let's buy most of the market. Typically over time, index funds have done very well. But the thing to remember is that as companies get more and more overvalued, if particular companies are getting more and more overvalued, they are getting to be a bigger and bigger part of that passive index. And so what that means is that you end up buying more and more and more of the expensive things and less and less and less of the cheaper things. What's particularly frightening now, where there's so many quantitatively driven funds, is that as things go up, so their backward-looking volatility looks great, their upward-looking price move looks great, funds like this can end up buying more and more and more of them. And so you get this movement that looks like this, where people don't recognize global stock markets are high, not because everything in them has moved up, but really because this one swath of stocks that are really loved right now has gone like this. And a lot of other stocks have actually gone like this. We want to be buying these ones because we think that over time that probably reverses. So now more than ever, it's really important to be a bargain hunter when you're looking at equity markets. I think the absolute hardest thing about being a contrarian investor is that it is much more difficult to be wrong and alone than it is to be wrong in a group, right? That's just human psychology. So think about the property bubble in the US before that crashed. It was very easy to say, oh, I lost all this money, but so did everyone else. Everyone lost all that money, so, it doesn't feel so bad. When you're buying the thing that even your mom is telling you is a dumb idea, those are the cheap things. They're the things where the mass psychology says, oh, stay away from that. When you're buying that thing and you lose money, everyone looks at you and says, well, come on, everyone knew that was a dumb idea. And so to be willing to look stupid is a really important part of winning over the long term in contrarian investing. You've got to be able to not break even when things are moving in the opposite direction to where you think that they're going to go. And there's a point in value investing that I think comes in every cycle where you start to see other funds breaking and you start to feel more, am I missing something? Is this the one cycle where it's not going to revert? Has everything changed? And then typically that's about when the bubble pops. And so it's all about holding your nerve longer than the rest of the market. And at Orbis, we've built our entire fund around making sure that we don't flinch when markets are going in the opposite direction. You need to have two qualities which sometimes are seen as contrasting. So you have to have the confidence to be able to do something that everyone else thinks is stupid. But you also have to have the humility not to just anchor on what you think is right and not be looking at the signs. You've really got to have both.